Hey everyone, and thanks for jumping back into the Cryptoverse. Today, we're going to talk about Bitcoin within the context of the Treasury yield curve. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out Into the Cryptoverse Premium at intothecryptoverse.com. I will be at Bitcoin Miami next week, so I'm looking forward to meeting a lot of people on one of the days. I haven't fully figured out when yet, but I will let you know. We're planning on having a little area so that I can meet people, like a place that people know I will be. So do be on the lookout for that. What I want to do in this video is talk about the Treasury yield curve, the inversion of it, look at Treasury yield spreads, and also with relationship to Bitcoin. All right, so if you're not familiar with the Treasury yield curve, this is what it currently looks like. If you're also not familiar with it, this is not what it normally looks like during normal times. In a normal environment, when the market is relatively healthy, you would expect the Treasury yield curve to look something like this. And the reason you would expect that is because one would expect that your annualized yield would be lower for lower time frames and higher for higher time frames, right? It's the whole idea about locking money up for longer periods of time. You would expect a higher annualized yield. So that's what it looks like in normal times, right? This is what it looks like when the market is relatively healthy. I mean, it doesn't mean that you can't have bad moves in the market, right? It doesn't mean you can't have major corrections, but this is what it looks like when times are good, right? And you can see me scrolling up here through the years, right? Looking at this is 2010, 2009. But what do you think it looked like going into the financial crisis? It looked like this, right? This is what it looked like back in 2007. And if you go back to the dot-com crash, the Treasury yield curve looks something like this. This is what it looked like in the end of 2000. And here is 2001 and then the early phases of 2001 all the way into 2002. But we need to remind ourselves of an important thing, and that is that when you see an inverted yield curve, it does not mean that just because it's inverted that you're in a recession. In fact, history would show us that typically upon the inversion of the yield curve, you're not in one, right? That's one of the times when you can usually point to not being in one, is when you get the inversion of the yield curve. Usually, it's sometime down the line, typically upon the uninversion of the yield curve, right? And the reason that's the case is because in order, when we go through a rate hiking cycle where the Federal Reserve is raising rates, they typically will raise and hold them high until they break something, right? That's just normally what they do. And this time is much more likely that they're going to do so than in many other times, because this time we have high inflation, right? They have less incentive to pivot to cut rates when inflation is high. Now, if inflation were at 2% right now, they probably would already be cutting rates. But because it's not, again, they have the incentive not to do so. So we do have to remind ourselves that during a rate hiking cycle, the Federal Reserve they'll keep these rates elevated for as long as they can, but then at some point they're forced to cut. Now, we have to think about, why would they cut? Normally it's because something bad happens in the economy, okay? And by that point, by the time the Fed cuts to come to the rescue, it's not like their pivot in monetary policy is going to immediately make everything better. In the same way that raising rates doesn't immediately kill the market, right? It's a long process, a slow grind down. When they cut rates, it's not going to immediately rescue the market if history is any indication. It doesn't mean that you won't see some type of new behavior from one cycle to another, but in general, that is what history shows us, is that upon the cut, that is usually not necessarily a great thing for the economy and for risk assets in general, because we have to think about what would cause the Fed to cut. Now, before I go too much further into this, I'm going to go look at the probabilities here. So looking into June, market's expecting about with an 85% chance or so, 84.5% chance that the Fed's going to pause, 15.5% chance that they're going to raise another 25 basis points. Like, I mean, I got to say, with core CPI, around 5.5% and unemployment rate at a 50-year low, I do think that the Fed is going to stick with their higher for longer mantra. That doesn't mean they have to raise at the next meeting, but I don't really see them cutting any, immediately either, which is really in stark contrast to what the market is predicting, with a cut coming as early as September, which is kind of interesting to think about. The Fed's been pretty clear they don't want to do that, and we know why, right? Inflation's relatively high, so you have to wonder, right? Why does the market think they're going to cut in September? I wouldn't think they're going to, um, but why does the market? So there's some smart people out there that think that the Fed's going to cut in September. So why is that? Well, I imagine they're guessing that something bad's going to happen, and it's going to force the Fed to cut. So that is the thing where a lot of people want the Fed to cut, but the problem is if they cut, it's usually because something happened, right? Like something bad happened. Not because they're cutting because they want all of us to enjoy bull market gains again. No, they're usually cutting because they've fundamentally broken something somewhere, and they need to loosen up monetary conditions just to make sure the whole thing doesn't come crumbling down. So you have to think about, like, why would they cut, right? And again, it would be because something bad happens if it's going to be as early as September. Okay, so going back to the Treasury yield curve, when you see it like this, it doesn't always mean that danger is imminent. I mean, even if you go back to say, like, the 2007 inversion. I mean, it was inverted in August of 2007, but a lot of the meltdown in financial markets didn't really come until 2008 and 2009, when the yield curve looked a lot more normal. So let's be aware of that, okay? We can talk about inverted yield curves, but I've been steadfast in my approach to, look, guys, an inverted yield curve does not necessarily mean you immediately fall into a recession. Normally, it's upon the uninversion, or at least further down the road. So that's one thing to consider. So again, this is what it looks like today. We're mostly looking at a full inversion. There is a couple of exceptions here. The 2-month is lower, possibly because there's a lot of demand for the 2-month. Therefore, the yield is lower, due to relationships and timeframes for the debt ceiling crisis. So I'm guessing there's a lot of investors that think the debt ceiling crisis will be resolved within 2 months, and so there's a lot more demand for the 2-month Treasury yields, as opposed to say, like, the 1 month, and therefore the yield on this has gone down. By the way, we saw the same thing happen with the 1 month not too long ago. It was actually the 1 month that was all the way down here, and I think it was because back then investors were thinking, well, 1 month from now should be before the debt ceiling crisis, right? So they can get paid out their yield before that we get to that point. But now that the debt ceiling crisis potentially happens within the next month, the demand for the 1 month is not as high. Therefore, the yield has gone up quite a bit. Okay, so if the demand is higher, then you would expect the yield to be lower, and if the demand is lower, then you would expect the yield to be higher. So that's just something to think about, right? And we can sort of just play this if you want to see what it looks like through the years. This is sort of just going, and you can see up here the years like 97, 98, 99, and you can just see, like, when it inverts, it can last for a little while, but then again, we typically get the uninversion of it. We go into a recession, and then we just repeat the business cycle over and over and over again. And now it's coming up on 2019, 2020, and then here we are in 2023. So before we get to Bitcoin, let's look at Treasury yield spreads. And again, we have the price of Bitcoin here in the background. But before we just simply look at that, let's look at actually the S&P on here, and then we'll switch it back to Bitcoin. So when you look at this and you look at the Treasury yield spread, so this is spread on the 3-month and the 10-year, you can see that in recent history, right, when it inverts and then uninverts, it's normally after it's uninverted that you get into that recession, right? Same thing, this was back in 2000. Here we go in 2007 as well, and even 2020, and even 1989, and so on and so forth. Again, we don't really have data going back further. You can see there's a period here where it is inverted and we're in a recession. But what you can see is that in all of these cases, when it becomes inverted, it's not a recession, but it's upon the uninversion that it actually occurs. And You'll also notice, right, that when it uninverts, the market does not normally like that, right? The market tends to go down during that time. So, right now we've had this sort of this uninversion here since October, and the stock market has just been climbing the wall of worry. Why shouldn't it, right? I mean, everyone's calling for a recession forever, whether they called for two consecutive negative quarters of GDP for the reason or whatever it might be. Um, it hasn't manifested itself yet, right? I mean, companies are still doing somewhat okay, although I think I think some of that is due to just lowering their expenses via a lot of layoffs. Inflation has likely contributed a significant amount to that. So if we get into a period of rapid disinflation, that should hit the bottom line on a lot of these companies. But the market here continues to climb the wall of worry. But that's not different than what it normally does, right? It's you can see here, right? It became inverted, and then the market still climbed the wall of worry. Here it became inverted, and then when during this time it sort of leveled off, right? And then upon the inversion it really started to sell off. So again, what you have to be aware of is that the market can ignore everything for a long time, but the issue, and we talked about this before, is the labor market, right? And the unemployment rate. And the labor market matters a lot, and it doesn't really matter at all until it does. And then once it matters, it's the only thing that matters. It hasn't really moved yet. We are starting to see some initial claims higher than what we've been seeing, so there are some warning signals going off. But until we see the deterioration of the labor market, you might not see this really flip in any meaningful way back up to the upside. But it's upon that flip that I think a lot of investors are sort of preparing for, planning for, trying to figure out how do they want to be positioned during that time. Now, what I want to do is I want to overlay Bitcoin because, of course, the video has Bitcoin in the title. And unfortunately, we don't really have a whole lot of history for Bitcoin and the yield curve inversion. But we do have one data point, and one data point is better than nothing. We can't really extrapolate anything from it, of course. But what you'll see is that there was actually an inversion in 2019, just like there's an inversion now in 2023. Although this inversion kind of puts this one over here to shame, right? I mean, this is nothing. The 2019 inversion is kind of nothing compared to this. And you could argue that the 2019 inversion predicted the recession. Now, I know I lost a lot of people there, but I will say this. Inversions don't necessarily predict a specific event, right? Like, it's not like the inversion of 2019 predicted the pandemic. We know that. But what I would say is that the inversion, meaning, in this case, the 3-month is providing a higher yield than the 10-year, right? Which fundamentally is not a great thing. But what I would say is that it predicts that the economy is going into a very fragile place, and therefore it won't take much to push it into a recession, right? That's sort of what it's saying, right? So it doesn't mean that it's predicting exactly what's going to cause it, okay? But it says, you know what? The market's in a fragile place. And only one more thing, and likely the stock market just says, all right, to hell with this. Let's just throw in the towel. There's no more sense in fighting this. I think that's what you can make the case for, right? We're not saying that the inversion predicted the pandemic. What we're saying is that the inversion predicted that something was likely going to happen to kick us into a recession. What it was, no one really knew. Now we know, right? You can go back and find similar things every single time, right? Every single time we get these inversions, you can see a recession follows. The reason for that recession can be different every single time, but again, I would argue that it's the inversion of the yield curve that shows you the economy is getting sick. And then at some point, there's going to be a narrative that takes over to say why the recession occurs. But at least the yield curve is sort of implying that one is coming at some point in the nebulous future. So going back to this and looking at Bitcoin, what you'll notice is that by the time the inversion reached its deepest point for the spread on the 3-month and the 10-year, the high for Bitcoin in 2019 was already in. Okay, so the deepest point here was in September of 2019. Bitcoin peaked in June. right? In June, the end of June. So, you essentially had 3 months. So 3 months. So Bitcoin peaked, and then 3 months later, we had the deepest point of inversion or the deepest spread, anyways, on the 3 month and the 10-year yield. So where are we today, right? I mean, like, where do we stand today? Well, at least right now, Bitcoin hit a local top in April, mid-April. Now, is it the high of 2023? I think there's reason to believe that it could be. It doesn't mean that it has to be. I mean, we've said before, right? Like, Bitcoin could have another push higher. I do think, I'll just put this in there, right? I do think that the dominance goes up either way, right? Whether it goes up or down. And you can of course look today and say, well, the Bitcoin dominance is back below 48%. You know, at this point, I don't really feel like I should have to defend this thesis. I mean, we've seen the altcoin market just systematically bleed back to Bitcoin. Of course, there's going to be some days where the dominance goes down, but in general, it's still holding up fairly well. So, what does this mean then? I mean, if this is the local high in April, then are we still looking for the deepest inversion? When did the deepest inversion occur? Well, it occurred about 10 days ago on May 3rd. Now, again, the bond market thinks we're going to see some cuts relatively soon, right? Starting in September. And some people think cuts are going to start as early as July. I mean, it's not a negligible percentage, almost, a little over 29% of participants, the probability anyways, the 29% probability is saying we get cuts in July, right? So there's some people betting that we get cuts in July, as weird as that might sound. So if you do see cuts as early as, say, like July or September, then you really are getting into the point where it's 3 to 4 months out from a potential local high for Bitcoin. Now, if Bitcoin goes up higher, then of course we kick the can down the road. But I think that when you think about what happened in 2019, if you look closely, what you'll notice is that once we got inverted, Bitcoin went up, right? So Bitcoin went up during the inversion process. But once this reached the lowest point, the top was in. And then when this went back up, that's when Bitcoin went back down, right? So like it went back up. During that process, we got the recession. Bitcoin bottomed during the recession, right? Not at the very end of it, right? But during it, which is what we've always said, right? Like the risk assets tend to find their bottom during the recession. In this case, it was a higher low, but it was still a significant bottom that we rallied off of. And it was worse back then than it actually looks on the screen. I mean, you can see that because we only use daily data, it only shows us going back down to around 5.39 thousand, right? Just below 5,400. We know there was a wick that went down to 3,800, which was not that far off from it was basically this price right here. It was really close to this prior low. So this chart does not really do it justice. We went much lower than this. We went all the way down to right around here on the chart when you include hourly wicks. So it was a higher low, but only by about $700, because 3,100 up to around 3,800 is a pretty significant event. Now, we've talked about this for the duration of this year, right? We said, look, guys, we're likely going to have about half the year go up and half the year go down, right? I don't know, it's hard to know exactly what order it comes in, but the point is that we spend half the year getting the bears wrecked. We spend half the year getting the bulls wrecked. Then we all get sufficiently wrecked, no matter what side you're on. Now, maybe some people switch sides at the best time, but right, if you're, I'm not saying it involves any particular person, right? Because people can flip their bias, whether they're bearish or they're bullish. But collectively, right, the bears get wrecked for half the year, the bulls get wrecked for half the year. We all get sufficiently wrecked, right? So we can see that, right? We can see that that's what happened in 2019. Inversion, Bitcoin rallied. Once the deepest point of the inversion was hit, the high was already in 3 months before. During the uninversion process, Bitcoin went down. And then we had a capitulation that finalized the business cycle, where we basically put in a higher low by $700. Okay, where are we today? Well, we had the inversion, right? Bitcoin first sold off due to FTX. I mean, we can say whatever narrative we want, right? We called for this drop in November. I mean, look, guys, I get plenty of things wrong. Like, I'm not going to pretend like I don't. But, about a week or two before this and throughout the entire summer, I said we should expect another sell-off by the end of the year. Everyone goes into Q3, they fall for the bear market rally, and then they get wrecked in Q4. And in November, there were a lot of people saying it's not going to happen. They were saying that June was the bottom because of all these different indicators, whatnot, right? The idea thinking this time is different, and we got a sell-off. Now, again, you could say, well, it's because of FTX. I don't really care what you call it. I mean, the fact is, it went down, and a lot of people thought June was the bottom, and it wasn't, just like it wasn't in 2018 as well. So it was just the same thing. The narrative is slightly different, but it was the same thing, and you can call it whatever you want. That's what happened. Now, 2023, the macro does seem a little bit worse in 2019, and maybe a little bit is putting it lightly, but it's not necessarily as bad as it might necessarily. I mean, as bad as it might seem. I mean, there is a lot of liquidity out there. I mean, the Fed did print, like $6 trillion. Okay, so there is liquidity that the Fed is trying to sort of reabsorb, get it out of the system. It's just taking a long time. So that's one of the reasons why I think that this process has taken quite some time, is that there's just been so much liquidity provided to the markets, and it's not just going to disappear overnight. It takes a long time for a lot of that liquidity to disappear. So, yes, this inversion does look a lot worse than this one. There's also an extra $6 trillion. Okay, so it's not just black and white. Be that as it may, we still have to wrestle with the idea that at some point during the cycle, we don't know when it's going to be exactly, but this is going to start to go back up. And when it does, we're probably going to get a recession. And when it does, you're likely going to see risk assets not do so well. Okay? I think this process is likely going to start. I've said before, right? I think we likely get a recession in either the second half of the year or the early part of 2024. That's my best guess. What's interesting is we had a recession in March of 2020 of the halving year, just before the halving, 2 months before the halving. Now, isn't it interesting that things might play out in a very similar fashion once again? You get a low, you get an inverted yield curve, Bitcoin rallies for half the year in 2019. The uninversion process takes place in the second half of the year, Bitcoin goes down. And then when everyone thinks the coast is clear, right? We rally into it, and then we get a recession, and we sell off to the prior low, right? Basically around the prior low, $700 higher, right? And you can kind of see the same thing happening again, right? I mean, we have the inversion of the yield curve, Bitcoin rallied. At some point, it's going to roll over, and it could be somewhat soon. I mean, this here peaked, or the inversion was the deepest point in August of 2019. Now, why is August of 2019 relevant? Well, because in September of 2019, right, let's go take a look. So here's 2019. You can see that, well, I guess in August, the Fed started to cut, right? August they cut, September, right? You can see the Fed really started to cut in late 2019. So then at some point, we have to go through that process. Now, I don't know when it's going to occur, right? I don't know. But at some point, we need to go through that process of seeing these rate cuts. There are some differences that I think it's worthwhile to point out. Not every cycle is, every cycle has some different behaviors, right? Like this time we have high inflation, right? This time we have a more hawkish Federal Reserve than last time. Last time we had an inverted yield curve, but still the Fed only got up, to like what, somewhere between 2 to 3% for the Fed funds rate. Now we're at 5.25%, right? I mean, we're a lot higher than we were over here, so it's not the exact same thing, but the process is similar, right? Like the process is somewhat similar. And I've put out one idea. I mean, I don't know if you should take it to the bank, right? I don't really think so, but it's one idea. If you look last time, what you'll notice, in fact, is let me overlay Bitcoin onto here because that might be more useful than looking at the S&P. Once the Fed hit the terminal rate last cycle, that's where Bitcoin bottomed. And then once the Fed started to cut, that's where Bitcoin topped. Isn't that interesting, right? Bitcoin bottomed at the rate, at the terminal rate, and then it rallied during the pause until the cut. and then during the cut it went down. What's going on this time? Well, first of all, it's too early to say. We don't fully know if the Fed's at the end of their rate hiking cycle. If they're not, then you could still argue that this process hasn't happened yet. Another way to think about it is that the Fed is so far behind the curve, that they've botched this whole process, and they should have started raising a full year sooner. Is one argument. And so normally they're raising rates during to good times, right? Here they've been raising rates during bad times. And so I did put forth this idea a few months ago, and I'm still waiting. I don't really know if I believe it yet or not, because I think we need to kind of see what happens here in the next couple of months. But just to put this idea in your head as well, there is one idea that says, well, what if the market treated the pivot, or the move from 75 basis points to 50 basis points as the pause, right? Now, I know what you're thinking, right? What's been smoking, right? But let's just think about it for a second. What if the market treated the transition from 75 basis points to 50 as the pause? If you think about it, right, that's right around when Bitcoin bottomed. It hit this bottom here. It's at least a local bottom, right? We don't know yet if it's the final bottom, but it's at least a local bottom. In 2015, we retested the bottom. We actually went lower on some exchanges in Q3. So just remember that. I know everyone points to 2019 and 2020, but we came really close to putting in a new low even in 2020. And you have to wonder, what if the Fed didn't print $6 trillion, right? Would we have bottomed at 3,800, or maybe we would have gone lower? I don't know. Again, we can find a narrative for anything. But what if the Fed, or what if the market is treating the transition from 75 basis points to 50 basis points as the pause, which I know it's kind of weird, and then they're treating the pause as the pivot. Now, again, I don't really know that I believe it, but I just want to explain why I'm saying it. Normally, the Fed raises when the economy is strong, okay? And then when they pause, they raise when the economy is strong. They keep raising once there's, a little bit of weakness. And then at some point, they're like, oh, crap, we probably should pause. This is getting pretty bad. And then they start to pivot. And then the market, during this phase, right, during the pause, the market prices in the rate cuts before the rate cuts happen. So by the time you actually get the rate cuts, the market actually then sells off, because they're like, oh, well, the Fed broke something. This is going to be bad for a while. This time, the Fed raised well after they should have, when the market was strong, and they raised when the market was weak. And so there's a lot of liquidity in the system, right? I think there is a lot of sort of desperation for the Fed to show any type of dovishness. But if this theory does hold water, right, then that means that they started raising way too late. Therefore, maybe the market is sort of thinking of the transition from 75 basis points to 50 basis points as the pause, the transition from raising 25 basis points to zero, the pause, might be treated as the rate cuts. Well, what would that mean? If it's treated as the rate cuts, then that means that Bitcoin goes down, because this is what normally happens during that time. But then what happens if, by the time the Fed actually cuts rates, let's say late this year, early next year, or whenever, maybe mid next year, I don't know. By the time they do that, perhaps the market then rallies, right? I mean, again, like, that would be a this time is different, and that's why I'm not looking to take this thing to the bank. I'd like to see kind of how the market plays out here over the next few months. It's not going to affect my portfolio at all. I've told you guys, my general strategy during these times. I'm in wealth preservation mode. Altcoins, in my opinion, remain way too risky. I don't really care what people think. I still look at the altcoin market and say, well, you know what? Most of the altcoins keep bleeding back to Bitcoin. You can find a few meme coins created last Wednesday that haven't, but most of them are going to go to zero in a few months anyways, more than likely. So I think it's the theory. It's probably not a correct theory, but it's at least something to think about to maybe keep us on our toes. And again, one reason to maybe put at least a little bit of weight into it is that, the Fed in most circumstances would have pivoted long ago with the economy the way it is. The fact that they haven't is certainly putting some interesting competing metrics up against one another. But again, like, this is all going to depend on what plays out here. If the Fed pauses in June and Bitcoin just sells off, and that could be more evidence for that theory. If, on the other hand, Bitcoin rallies after a potential Fed pause, then that would sort of detract away from that theory. Now, I think the Fed is purposely not wanting to give this idea of a definitive pause because I think they're worried that if they do, then the market's just going to rally. And if the market rallies, people feel richer, and if people feel richer, they go buy more things, which puts more pressure on inflation. And then if more pressure comes on inflation, then the Fed's going to have to sort of restart up interest rate hikes. So I think they really want to avoid that, and so they're not really telling the market that they're going to pivot just yet, or they're not telling the market that they're going to pause. They want to leave it open to the idea that they won't. And I think the reason they're doing that is because they like to see, things come back down between now and June, so that maybe they don't have to raise another 25. But if inflation stays high, if the unemployment rate stays low, and if markets just keep on rallying, then they might be forced to just go up again. And they'll probably just go up until the market caves. And if the market's caving now, between now and then they probably don't have to keep going up, right, with interest rate hikes. So it's just one theory. Again, it's nothing to take to the bank, and I don't really necessarily believe it myself, but it is an interesting dynamic that we saw Bitcoin find at least a local low near the time the transition from 75 to 50. We at least saw the stock market find a local low at that time. And so, the next obvious thing to look for is, well, what happens when the Fed pauses? If the markets just sell off, then that's evidence to that theory. If the markets rally, then that theory is dead in the water. So we'll see what happens. Stay tuned. So I think that the thing you have to consider when thinking about like why the bulls get wrecked and why the bears get wrecked, the bears get wrecked because the market just sort of climbs the wall of worry during this inversion of the yield curve. I mean, it seems like things are really bad, but because the labor market hasn't deteriorated yet, right? The market just ignores it. So then the bears get wrecked. And then that gives the bulls a false sense of security to think that they're always going to be right. And at some point, the labor market does fold under the pressure, and the Fed has to take action, and the market prices in those rate cuts, and then the bulls get wrecked, right? And then everyone gets wrecked. So I think it's going to play out in a very similar way. And what's interesting is we could have a very similar dynamic, right? Where you see the uninversion of the yield curve, Bitcoin sells off, right? And everything kind of seems normal. And we're like, wait, do we get a recession? Do we not? Normally, if you look closely, you get a recession. You sort of see that uninversion, and it's not always immediate that you get a recession. So there's this period of a few months sometimes where you might get the uninversion, and you're like, maybe there's not a recession, And that actually what's happened last time in 2019, right? We got an inversion, Bitcoin went down, but then we're like, well, still not a recession. Bitcoin rallied on up, and then we got a recession in early 2020. Maybe we'll see something very similar, right? I mean, maybe, Bitcoin's climbed the wall of worry as this has gone down. At some point, this goes back up. Bitcoin probably sells off. And then if we get the uninversion and there's not an immediate recession, it might give us all the false sense of security where we're like, all right, well, the halving's only 4 months away or something. At this, again, from now, it's 11 months away or so. But maybe by that point, it's like 4 months away. And we're like, well, the halving's 4 months away. Maybe it's time to start getting, changing our tune here. And then the recession hits, right? And then you get the final sell-off just before the next halving or something. I don't know. It's something to think about. But you can really see a lot of similar dynamics playing out that we saw in 2019 and in 2023. It's just that the macro is a lot worse than it was back then. But to counteract that, there's also a lot more liquidity today than there was back then. So you can look at it a few different ways. But I thought it was useful to sort of go through this yield curve exercise. You can also look at the inversion of the 2-year and the 10-year if you want as well. Just to give you an idea of kind of like what the market has done there, and we can sort of zoom out here, and you can see the 2-year and the 10-year. But again, the problem here is that Bitcoin's only existed for very, very little history, and so we have all these different indicators for during a period of historic QE and low interest rates. This is the first time that Bitcoin's really having to experience this deep of an inversion of the yield curve, and a Fed that is more hawkish than my generation has really ever seen them be. So just something I think for us all to consider. Let's see where June brings us with the Fed funds rate. If they pause, then we'll get to see what the new dynamic is for risk assets, and then what that would mean for potential rate cuts later on in the business cycle. Anyways, I think we will wrap it up there. Maybe there's one more thing. I did mention initial claims, so the labor market has held up relatively strong so far. Initial claims have started to move up again. So they were in this range here for a while, right? Like around the 240s, 230s. And recently, this last week, it jumped up to 264. So it's kind of a warning sign. You might say, well, does that really mean anything? Yeah, I think so. If you go look at the unemployment rate versus continued claims and initial claims and recessions, I mean, I'm not going to go through each one. You can pause the video and look at it. Normally, continued claims and initial claims lead the unemployment rate higher. It can take 6 months or more. A lot of times you'll see initial claims bottom well before unemployment does. And if we hide continued claims and even recessions, right? I mean, these are diverging. The initial claims going up, unemployment rates going down. It's not dissimilar from what we've seen in the past, right? Here you can see initial claims bottomed, unemployment rate kept going down even though the initial claims went up, but then at some point the unemployment rate finally went up. You can see this over and over and over again. So I think there is some warning signs coming from the labor market, some signs of distress, but it's going to likely take months for it to really be felt throughout the entire economy. I think, maybe 6 months from now, it'll all be a little bit more apparent, but it's a very slow process. I know that if you're in crypto, you're kind of used to this just like really fast-paced world, but the business cycle is not a fast-paced world typically, right? I mean, I know 2020, what happened there was very quick. That's not the norm. Normally, as history shows us, the cycle takes a long time to play out. And that's why the market makes, especially bear markets, make fools of both bulls and bears, because you can look at it and say, well, it looks really bad, but the market can rally into that wall of worry for a long time, make everyone get lulled into a false security, and then you get the recession, right? When everyone's least expecting it. But anyways, thank you guys for tuning in. Make sure you subscribe, give the video a thumbs up, and I'll see you guys next time. Bye.